Are big diamonds immune to economic downturns? The rarer the diamond, the more it's desired, the greater its value, and the more resilient it tends to be during volatile market conditions. That should also mean the companies supplying these diamonds are more resistant to such downturns, right? Well, this is why Lucara Diamond Corporation's latest earnings report was so striking and worthy of our attention. The mining company has again raised uncertainty over its ability to continue as a going concern after breaching a loan condition related to funding the underground expansion of its Karowe mine in Botswana. Lucara warned that its lower revenue guidance for the year, weak cash flow, and the loan breach could leave it short of the liquidity it needs to maintain operations over the next 12 months unless it secures new funding. Now, some of this reflects the broader challenges facing the diamond mining sector, but on the surface, Karowe should be one of the more profitable and liquid mines in the business. It consistently produces large stones above 10.8 carats, known as specials, that command some of the highest prices in the industry. Production of these specials jumped 24% in 2024 to 807 such large rough diamonds and rose another 4% in the first half of 2025 to 381 stones. That should boost earnings. And financially, the first half wasn't all that bad on the surface. Profit more than tripled to around $12 million, but mainly because of lower expenses, while revenue fell 8% to $74 million. And that revenue drop is curious given the continued rise in higher value production. Looking at overall group revenue, a 4% increase in the average price achieved only partially offset a 12% drop in the volume of carats sold. And that forces us to consider Lucara's sales strategy to gain a better understanding of why that is the case. Most of Karowe's general run-of-mine production is sold via tenders, with some goods still traded on the Clara platform, which Lucara used to own but has since divested from. But all its specials, those beautiful, large, high-value rough diamonds, go to a single buyer, HB Antwerp, under a profit-sharing arrangement. HB buys the rough from Lucara, polishes and sells the stones to the market, then pays Lucara a top-up based on the final sales price of that polished. Now, I don't know the full mechanics of that agreement, but it does feel that Lucara could get more bang for its buck by auctioning off those coveted specials, letting buyers compete and outbid each other, reflecting the state of demand in one of the few segments of the market that tends to hold value regardless of market swings. That said, Lucara's sales through the HB agreement have surged, up 12% in the first half of the year, making up 72% of group revenue versus a historical average of around 60%. Now, we don't know exactly how prices influenced that dynamic. Lucara did not disclose separate pricing information for its specials, but it seems the jump was likely volume driven given the spike in Karowe's large stone production. So it begs the question,